January 9th, 2026, a day that shattered a 40-year relationship in the precious metals market. Gold held steady at record highs, while silver collapsed, down over $73 in early trading. For the first time in this historic rally, these two metals stopped moving together, and what's unfolding between now and January 15th could determine whether the wealth serious investors have built survives the next 6 months, or gets wiped out in the coming storm, because two massive technical events are converging within 48 hours, and most capital allocators have no idea what's about to hit them. Thursday, January 9th, 2026. Traders across New York, London, and Singapore watched their screens with growing concern. Something unusual was happening in the precious metals market. Gold closed the day at $4,487, up $20.80, demonstrating strength that surprised many analysts. The yellow metal had stumbled earlier in the morning, briefly touching $4,415, but recovered with deliberate, methodical buying. Institutional investors were stepping in, providing support at every dip. Silver told a completely different story. The white metal finished at $76.89, down $1.30, a decline of 1.67%. But this closing price masked the real violence of the day. During early morning hours, silver had crashed to $73.52, sending shockwaves through commodity desks worldwide. Veteran traders who had spent decades in precious metals markets paused. They recognized what they were witnessing. For 18 months, gold and silver had moved together, rising and falling in near-perfect synchronization. When gold rallied, silver amplified the move with even larger percentage gains. When gold pulled back, silver followed with proportionally bigger declines. This relationship had existed for over 40 years. Traders built their careers around it. Risk managers designed hedging strategies based on it. Algorithms were programmed to exploit it. The correlation was so reliable, so consistent, that it became an unquestioned foundation of precious metals trading. Portfolio managers used it as a risk management tool, hedging positions in one metal with offsetting exposure in the other. But Thursday broke that pattern. Gold held firm while silver crumbled. Experienced investors understand what correlation breakdowns signal. They reveal that something fundamental has changed beneath the surface. When long-standing relationships between assets suddenly fail, it means the underlying forces affecting each asset have separated. The markets are pricing in different future scenarios, different risks, different outcomes, different trajectories. For business owners and institutional investors who had grown comfortable with synchronized precious metals movement, this divergence created immediate problems. Hedge positions that were supposed to provide protection suddenly weren't working as expected. Trading algorithms that relied on historical relationship patterns began generating conflicting signals. Risk models that had been calibrated using decades of correlation data started flashing warning lights across trading desks. The question facing every serious capital allocator became obvious. Was this divergence temporary? A brief technical anomaly that would correct itself within days, allowing traders to return to familiar patterns? Or was Thursday's price action the beginning of something more significant? A sustained decoupling that would require complete reassessment of precious metals positioning? Those who dismissed the divergence as meaningless noise, those who assumed the correlation would simply snap back on its own, were potentially exposing themselves to substantial risk. Because what happened on Thursday wasn't occurring in isolation. Broader market forces were converging, creating conditions for increased uncertainty across all asset classes. Gold's ability to maintain its position near record highs, even as silver struggled, suggested the yellow metal was receiving support from sources that silver was not accessing. Perhaps central bank buying had intensified. Perhaps safe haven demand was increasing due to geopolitical developments that hadn't fully appeared in headlines yet. Perhaps institutional investors were beginning to differentiate between gold's role as money and silver's exposure to industrial economic cycles. Whatever the specific cause, the market was sending a clear message. These two metals were no longer being treated as interchangeable safe haven assets. They were being evaluated on separate merits, with separate risk profiles and separate future paths. For portfolio managers, for business owners protecting wealth, for investors who had built significant precious metals positions, this divergence demanded immediate attention, because within the next 48 hours, two major technical events were scheduled to collide. Events that occur only once per year, events that move billions of dollars through commodity markets with mechanical precision. And most investors had no idea what was coming. The opening act had just concluded. The real turbulence was about to begin. Most retail investors had never heard of it, yet it moves tens of billions of dollars through commodity markets every single year. The Bloomberg Commodity Index rebalancing. A technical event that sounds bureaucratic, almost boring, until one understands its power to create violent price swings in precious metals. Every January, this massive index undergoes systematic restructuring. Fund managers adjust the weightings of component commodities based on the previous year's liquidity data, production volumes, and market conditions. Here's where it becomes dangerous. Passive investment funds tracking this index hold enormous amounts of capital, billions of dollars that must move mechanically. When the index rebalances, these funds have no choice, no discretion, no ability to wait for better market conditions, no strategic flexibility. If gold's weighting in the index increases, every fund must buy more gold, regardless of current price levels, regardless of technical indicators showing overbought conditions, regardless of whether the timing makes any strategic sense. If silver's weighting decreases, those same funds must sell, mechanically, systematically, without any regard for market impact. This creates what sophisticated traders call predictable order flow. Hedge funds and algorithmic trading desks position themselves days in advance, waiting to exploit the buying and selling pressure they know is coming. They can see it approaching like a freight train on a fixed schedule. And between January 9th and January 15th, that freight train was barreling toward the precious metals market. Historical data revealed a pattern. During previous rebalancing periods, bid-ask spreads widened significantly. Market makers adjusted for expected volatility. Intraday price swings amplified as competing algorithms clashed. Liquidity evaporated at critical support and resistance levels. The magnitude of these disruptions depended entirely on how significantly the weightings changed. Small adjustments produced minor ripples. But substantial reweighting, particularly in metals that had experienced extraordinary price appreciation like gold and silver, could produce waves that capsized poorly positioned portfolios. Smart traders were already repositioning before Thursday's close, reducing exposure, tightening stop losses, preparing for the whipsaw action that rebalancing typically brought. But there was a complication. Another catalyst landing at precisely the wrong moment. Friday morning. Less than 24 hours after Thursday's divergent performance, the United States Bureau of Labor Statistics was scheduled to release the monthly non-farm payrolls report. Employment data, the single most watched economic indicator for gauging Federal Reserve policy direction, and the preliminary signals were already raising concerns. Wednesday's data had shown U.S. job openings declining to a 14-month low, 7.7 million vacancies, below the expected 7.8 million. More concerning than the raw number was the trend it represented. Hiring activity remained subdued. New job creation was slowing. Labor demand was clearly weakening. For precious metals investors, this created an analytical puzzle that defied simple interpretation. Traditionally, weaker labor data supports gold prices. Why? Because it increases expectations for Federal Reserve interest rate cuts. Lower rates reduce the opportunity cost of holding non-yielding assets like gold, making precious metals more attractive relative to bonds and savings accounts. But the current environment wasn't traditional. The Federal Reserve had maintained a hawkish stance despite softening economic data. Persistent inflation concerns were preventing the aggressive rate cuts that markets had anticipated. Chair Powell had repeatedly emphasized that employment data alone wouldn't dictate policy decisions. This meant Friday's payrolls number carried unusual significance. A surprisingly weak report could reignite safe haven demand, sending gold surging toward new record highs. But it could also trigger recession fears, hammering silver's industrial demand outlook, widening the divergence even further. Conversely, a stronger than expected jobs report would likely crush remaining rate cut expectations, potentially triggering profit-taking across the entire commodity complex. So here was the situation facing serious investors. Two major technical events converging within a 48-hour window. The Bloomberg Commodity Index creating mechanical buying and selling pressure that no one could stop. The employment report potentially shifting Federal Reserve policy expectations in unpredictable directions, all occurring while gold and silver were already exhibiting abnormal divergent behavior, trading near historically elevated price levels. The probability of sharp directional moves had increased exponentially, but the direction itself remained unclear, creating a treacherous environment for anyone holding significant precious metals exposure. Experienced traders recognized what was approaching, a period where careful risk management would separate winners from losers. The technical storm was arriving, and beneath its surface, something even more significant was revealing itself about the fundamental forces driving these two metals apart. For 40 years, traders had relied on one of the most consistent relationships in financial markets. When the US dollar strengthened, gold fell. When the dollar weakened, gold rallied. This wasn't theory. It was mathematical reality, encoded in decades of price data, taught in every commodity trading course, built into countless algorithms. But something impossible was happening. The dollar index had risen 1.23% over 9 consecutive trading sessions. Gold should have collapsed. Instead, it remained stubbornly elevated, hovering near its December 29th record high. refusing to acknowledge the dollar's strength. A 40-year correlation had simply stopped working. Currency traders stared at their screens, rechecking their data, wondering if their models had broken. They hadn't. The market had changed. Something powerful enough to override 4 decades of market behavior was now in control. But what force could possibly be that strong? The answer was revealing itself in monthly data releases that most retail investors never examined. Central bank gold purchases, not small purchases, not tentative accumulation, aggressive, sustained, strategic buying by sovereign nations, China, Russia, India, Turkey, Poland. These weren't retail investors chasing momentum. These were central banks making multi-decade strategic decisions about reserve composition. They were buying gold regardless of price levels, regardless of what the dollar was doing, regardless of short-term market volatility. Why? Because they were diversifying away from dollar-denominated reserves, building positions in the one form of money that exists outside any government's control. When central banks buy, they don't look at technical indicators. They don't wait for pullbacks. They don't care about the dollar index. They accumulate steadily, systematically, creating a bid underneath gold that traditional market dynamics cannot easily overcome. Consider China's position. The country holds over $3 trillion in foreign reserves, yet its official gold holdings represent only a small fraction of that total. Even modest percentage shifts in China's reserve allocation, even moving just 2 or 3% into gold, represents billions of dollars of buying pressure, demand that occurs regardless of price, because the decision is strategic rather than tactical. This explains why gold defied the dollar's strength. Central banks were providing a support structure that industrial economic data, that currency movements, that traditional correlations simply couldn't penetrate. Gold doesn't care if manufacturing contracts, it doesn't care if corporate earnings decline. It responds to currency debasement, to geopolitical instability, to the erosion of confidence in fiat monetary systems. Tensions in Eastern Europe showed no signs of resolution. Russia's conflict with Ukraine had entered its 3rd year. NATO involvement had deepened. In the Middle East, regional conflicts continued destabilizing energy markets. Iran's nuclear ambitions created persistent uncertainty. These weren't temporary headline risks that fade after a news cycle. They represented structural fractures in the global order, the kind of persistent instability that keeps central banks buying and sophisticated investors maintaining positions, regardless of short-term price movements. Gold had become the ultimate monetary asset, insulated from economic cycles. But silver? Silver faced an entirely different calculation. Yes, silver benefited from some of the same safe haven dynamics as gold, but its price determination was increasingly dominated by something gold didn't have to worry about: industrial demand. And industrial demand is directly tied to economic growth. The silver market had tightened considerably over the past 2 years. Mine production had been declining, not because miners didn't want to produce more, but because silver is typically a byproduct of base metal mining. When copper and zinc production slows, silver output falls as well. Simultaneously, demand from green energy applications had surged. Solar panel manufacturing requires substantial quantities of silver. Electric vehicle production uses more silver than traditional automobiles. 5G infrastructure deployment consumes silver at rates previous telecommunications generations never approached. The supply-demand imbalance had created a structural deficit in the silver market, more silver being consumed annually than being produced, a situation that theoretically should support higher prices. But there was a critical vulnerability. If economic growth slows significantly, if recession fears intensify, industrial demand collapses quickly. Solar panel installations get delayed, infrastructure projects are postponed, manufacturing output contracts, and suddenly the supply deficit becomes irrelevant because demand has fallen even faster than supply. Silver's dual nature as both a precious metal and an industrial commodity creates higher beta to economic conditions, higher potential returns during expansion, but greater downside volatility during contraction. This fundamental difference explained Thursday's divergent performance. Gold receiving support from central banks, making strategic monetary decisions. Silver vulnerable to industrial demand concerns as economic data weakened. Two metals, once joined at the hip, now responding to completely different forces. The correlation had broken because the fundamentals driving each metal had diverged. And understanding this split was the key to positioning capital correctly for what was coming next. The clock was ticking. Friday morning's employment report would arrive in hours. The Bloomberg rebalancing would continue its mechanical execution. And somewhere in the chaos, fortunes would be made and lost. But the smartest investors weren't trying to predict which direction the market would move. They were positioning for both scenarios. Because successful capital allocation isn't about being right, it's about being prepared. Scenario analysis had become essential. If Friday's employment data showed strong job creation, robust wage growth, The market's reaction would be swift and brutal. Federal Reserve rate cut expectations would evaporate. Commodity markets would face immediate profit-taking pressure. Gold would likely decline, but its fall would be cushioned by central bank buying, by geopolitical risk premiums, by its role as the ultimate monetary asset. Silver, however, would face a double blow. Higher interest rates for longer, combined with industrial demand concerns, would trigger amplified selling. The divergence would widen further. But if the employment data came in weak, showing significant job losses, stalling wage growth, the market would face a different kind of chaos. Safe haven demand would ignite, propelling gold toward fresh record highs. Institutional capital would flood into monetary assets. Silver's response would depend on interpretation. Would weak employment be seen as disinflationary, supporting all precious metals? Or would it signal economic contraction, destroying the industrial demand that underpins half of silver's value proposition? This uncertainty was precisely why strategic investors were rethinking their precious metals allocation. The old approach, treating gold and silver as interchangeable safe haven assets, had become obsolete. These metals now required separate analytical frameworks, separate risk management parameters, separate position sizing methodologies. Gold offered something silver couldn't match: stability, lower volatility, insulation from economic cycles, institutional support that persisted regardless of short-term market conditions. Its proximity to record highs limited immediate upside potential, but its downside was protected by forces larger than any single trader or trading day. For investors seeking wealth preservation, for those prioritizing capital protection over maximum returns, gold represented the anchor position. Silver offered the opposite profile: higher potential percentage returns driven by the structural supply deficit, by accelerating green energy demand, by its industrial applications in the technologies defining the next decade. But this upside came with significantly greater risk. Economic slowdown would destroy industrial demand faster than it would tighten supply. Recession fears would trigger violent selling. Leverage in the silver market would amplify both gains and losses. For investors willing to accept volatility, for those with risk capacity to weather sharp drawdowns, silver represented the growth position. The strategic question wasn't whether to own precious metals. It was how to allocate between them, and how to size positions appropriately for the volatility ahead. Portfolio construction required new thinking. Traditional precious metals, hedging strategies that assumed correlation, that relied on offsetting risk between gold and silver, needed immediate recalibration. Multi-asset portfolios needed to account for the fact that these metals now responded to different catalysts, moved on different timelines, served different functions. Position sizing became critical. In elevated volatility environments, with major technical catalysts converging, with correlations breaking down, leverage magnified risk exponentially. Conservative investors were reducing silver exposure, tightening stop losses, preparing for the whipsaw action that rebalancing and employment data would likely trigger. Aggressive investors were viewing the volatility as opportunity, positioning for breakouts in either direction, but doing so with strict risk parameters and predefined exit strategies. Both approaches had merit. The choice depended entirely on individual risk tolerance and investment time frame. But one thing was certain: neither metal had exhausted its long-term momentum. Bullish structures remained intact on extended time frames. The fundamental drivers supporting precious metals hadn't disappeared. They had simply diverged. Gold would continue receiving support from central bank diversification, from geopolitical instability, from concerns about fiat currency stability. Silver would continue benefiting from supply deficits, from green energy transformation, from technological advancement requiring its unique properties. The next 6 to 12 months represented a critical positioning window, not because precious metals were about to collapse, but because the relationship between them had fundamentally changed. Traders who recognized this structural shift, who understood the divergent forces now in control, who allocated capital based on separate risk-reward profiles. They positioned themselves advantageously for whatever came next. Those who didn't, those who assumed the old correlations would simply return, those who failed to reassess their precious metal strategy, they faced unnecessary exposure to volatility they hadn't properly evaluated. The precious metals market had entered a new paradigm, and success in this environment required one thing above all else: understanding that gold and silver, despite being grouped together for 40 years, now walked separate paths. The major split of 2026 wasn't ending. It was just beginning.